Ladies and gentlemen, good day and welcome to Q3FY23 Results Conference Call of Dixon Technologies hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniruddha Joshi from ICICI Securities. Thank you. Over to you, sir.
Yeah, thanks Ryan. On behalf of ICICI Securities, we welcome you all to Q3FY23 Results Conference Call of Dixon Technologies India. We have with us senior management represented by Mr. Atul Lal, Vice Chairman and Managing Director, and Mr. Saurabh Gupta, Chief Financial Officer. Now I hand over the call to the management for initial comments and then we will open the floor for question and answer session. Thanks and over to you, sir.
Thanks very much, Anirudh. Good evening, ladies and gentlemen. This is Atul Lal, and we also have on call today our CFO Saurabh Gupta.
Yeah, good evening, everyone.
Thank you very much for joining this earnings call for the quarter ended December 2022. Coming to our overall performance for the third quarter, consolidated revenues for the quarter ended December 31, 2022 was INR 2408 crores against INR 3074 crores in the same period last year. That's a degrowth of 22%. Consolidated EBITDA for the quarter was INR 114 crores against INR 104 crores in the same period last year, a growth of 10%. Consolidated PAT for the quarter was INR 52 crores against INR 46 crores in the same period last year, a growth of 12%. We are pleased to report a strong performance on the margins front in this quarter, wherein the margins have expanded by 130 bps year on year. This is led by a change in sales mix, operating leverage, cost optimization, and efficiency measures across all businesses, and continued implementation of strategic price hikes across our ODM business of washing machine and lighting. Another highlight was a strong free cash flow generation post capex of 114 crores in first 9 months of the current fiscal. We have further strengthened our balance sheet with reduction in gross debt by rupees 223 crores in the same period, with net debt now of just 68 crores, with net debt to equity of 0.06 as on 31st December 2022. We are targeting to reduce our debt by another 50 crores before March 31st, 2023 and save almost 22 crores in interest costs annually. Our balance sheet strength and enough credit line from banks enables us to invest in long-term development for business. Our basic approach always has been to capital policy that emphasizes on return on invested capital and financial stability. We have successfully improved our ROC and ROE to 26.3% and 28.3% respectively as on 31st December 22, and we feel confident that same would keep improving in the current quarter and in the coming years on account of more debt reduction, working capital efficiency, and improved earnings. There is huge focus on cash conversion cycle and working capital management. Working capital days stood at positive 1 day at the end of the December quarter. Our cost optimization initiatives and proven working capital management will help us to sustain growth, profitability, and a strong balance sheet. We strongly believe we have a platform to sustain strong revenue growth moving forward through strengthening in the overall demand environment and addition of more customers, including some large accounts in mobile business. Now I'll share with you the performance and the strategy in each of our businesses going forward. Consumer electronics, the revenue for the quarter were 864 crores with operating profit of INR 26 crores and 3.1% operating profit margin, which is an expansion of 90 pips year-on-year. Year-on-year revenues were lower by 39%, led by 17% lower volumes, as Diwali was 1 month earlier last year. Also significant correction in prices of open cell in the international market. Similarly, in 9 months, despite 16% growth in volumes, year-on-year revenues declined by 21%. We have the largest capacity in India with annual capacity of 6 billion sets, including backward integration in LCM and SMT lines and catering to almost 35% of India's requirements. Our JDM business with our anchor customers is remaining strong, and we are in active discussion with other existing customers to offer ODM JDM solutions. We have closed the ODM sub-licensing rights with Google related to Android and Google TV, which will open up a lot of opportunities for us, since 60-65% of Indian market is on this platform. We should be able to roll out the same by Q1 of next financial year. As a part of our backward integration strategy, we will be starting injection molding in the segment for deepening our television manufacturing in the current quarter of this fiscal. We are also exploring newer products such as commercial displays used in public advertising and information displays, and interactive boards for use in educational institutions in this particular business. In lighting, the revenues for the quarter were 263 crores with operating profit of 24 crores with an operating margin of 9.1%, an expansion of 90 bps against Q2 numbers in line what we have been guiding. We were able to increase operating margins through combination of reductions in input prices, calibrating pricing action, inventory planning and value engineering. Apart from sluggish demands, reasons for lower revenues year-on-year is a reduction in commodity prices, freight rates and migration of renewable technology from driver-based to DOB, that's driver on board, which are 18 to 20% lower than the earlier technology SKUs. We are India's largest ODM player in lighting and have the largest capacity in various SKUs. In LED bulb, we have a capacity of 300 million, which is 45% of the Indian requirement. We already have expanded the annual capacity in BT buttons to 50 million and downlighters to 18 million. We are getting into new product categories like starting strips and rope lighting, which will be launched in March 23. We'll also launch professional lighting products in the course of 23-24. Our first supplies against exports to a new customer in UAE have been executed in Q3, and we have already received the repeat orders for Q4. In Q3, we completed the technology acquisition of Bluetooth mesh technology and work in process progress Wi-Fi solution for the smart lighting from iBand Illuminations, a premier smart lighting company. New product leveraging acquisition will be launched in Q1 of next fiscal. We have hired Kunal Chaudhary as head of R&D from Lighting Solutions. He is one of the most experienced R&D leaders in lighting industry in India. We are also in the process of strengthening R&D further in the space of smart lighting and professional products. We have also started investing under the PLI scheme for LED lighting components in line with our backward integration strategy, which will make us even more competitive. The new plant for LED lighting components in Dehradun will be again operational in March 23. The capital employed in this business has been reduced by 161 crores year-on-year on account of huge focus on current asset investment. Home appliances revenues for the quarter were 244 crores with an operating profit of 25 crores, that is 10.3% operating profit margin. The margins have improved both year-on-year and Q-on-Q, led by passing on the impact of commodity cost and exchange rate fluctuations to customers, improved operating leverage and cost optimization measures. We have 160 old models in semi-automatic category ranging from 6 to 14 kg with an annual capacity of 2.4 million. We have added more customers like Bosch, TCL, Oneida in the semi-automatic category. In fully automatic category, we have a capacity of 0.6 million with 96 variants across 6.5 to 11 kg with Bosch as an anchor customer. In addition to Bosch, we have started manufacturing for Lloyd, Roma, TCL, Akai, Oneida, Acer and Japanese customer Sharp. We are targeting more than 100% growth in this business in the next financial year. We will be introducing more designs with new features in both categories of semi and fully automatic and increasingly invest on making the segment more R&D driven to serve industry with the latest innovative technologies. The order book in this vertical, in this business for the upcoming quarters looks very healthy. Mobile phones and EMS division. Revenues for the quarter were 915 crores with an operating profit of 33 crores. That's 3.6% operating margins. We have got some large orders from Nokia for feature phones. We are working on 2 large customer acquisitions in this vertical, which I had shared in our last interface also. We are likely to close the first account in a week's time and expecting the second account to conclude by end of the current quarter. Both these customers can potentially add almost 6,000 crores in revenues annually. We have started the construction activity in our new 5-acre integrated facility in Noida, where in phase 1, we will be constructing almost 400,000 square feet. We have hired a very senior person as our R&D head for mobile phones from branded mobile companies, who will build a team of engineers and a lab in Hyderabad. Security surveillance systems, Dixon share of 50% of revenue is 118 crores with an operating profit of 2 crores. We are going in for further capacity expansion from 10 billion per annum to 14 billion per annum, and we are relocating our campus from Tirupati to Murthy Electronic Manufacturing Cluster, where we have taken 200,000 square feet constructed facility. It will be operational by March 23. Operating profit and margins in this business are down year-on-year in quarter mainly due to shifting expenses and duplication of the fixed cost structure. Telecom and networking products, our separate facility in Noida, which got operational in December 22, and we are on course to achieve thresholds of capex and minimum revenue the first year as per the PLI guideline. Airtel is the anchor customer, and they have a strong market share in ONT and set-top boxes. We have already supplied almost 0.6 million ONT to Airtel since we started manufacturing for them. We have also bagged a very large order of HD Zapper set-top box from Airtel, and the mass production to start by Q2 of next fiscal. Also, we have won large business of Android set-top boxes in partnership with global ODM. The development work has started in mass production to start by Q2 of next fiscal. This has potential to grow even to other geographies outside India. We are also in active discussions in this business with some other large global brands for existing and new product categories. We are also building a team for joint R&D with our partners to support our end customers from India. Laptops, tablets and IT hardware. The government is expected to come out with the revised PLI scheme for IT hardware, which is much more attractive and a higher incentive outlay. We will be participating in this PLI. Inverter controller board for air conditioners, a 4060 JV with Rexel, Japan, to manufacture these boards of air conditioners for Daikin. A new facility under the PLI scheme has been set up. The JV company is a beneficiary under the PLI. We'll make a total investment of 51 crores, where Dixon share is 20 crores over a period of 5 years, and we have already achieved the capex threshold in the PLI in the current financial year. Wearables and hearables for both brands, we get revenue of 85 crores in Q3, and in 9 months 230 crores of the current fiscal. Presently, we are manufacturing TWS and neckbands with more SKUs like Bluetooth speakers and smartwatches will be added in the new facility, which will be operational by March 23. In line with our strategy to deepen the level of manufacturing, the SMT for PCB will also be done in-house in the next financial year. In addition, we will be manufacturing TWS and smartwatches for Samsung with a dedicated plant in Q4 of the current financial year. A refrigerator, we have started the construction on 20 acres of land in Greater Noida, where we are creating a capacity of 1.2 million DC refrigerator under various sizes of 190 liters to 235 liters. We have positive response from a lot of global and national brands, and we expect the trial production to start in Q2 of 23-24. I would like to now stop here, and me and Saurabh are there to respond to your question. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Bhumika Nair from DAM Capital. Please go ahead. Bhumika, your line is unmuted. You could proceed with your question.
Hello. Yes, sir. Can you hear me now?
Yeah.
Yes, sir. So the first question is on the TV segment. While there would have been some realization decline which has led to the revenue decline, but can you give some color on what has happened in terms of volumes and how is the industry demand, and how are we seeing this segment going ahead, particularly with the Google Android license coming up? Where are we seeing the customer ramp up? So that's my first question.
So Bhumika, let me share the volume numbers and I'll request Mr. Lal to answer the question on the Google and Android license. See, one of the reasons why there is a decline in Q3, one, of course, the Diwali last year was in November first week. This year the Diwali was in October 24th. So clearly the peak sales for Diwali happened in Q2 and we had a very good Q2 as far as TV sales was concerned, both in terms of volumes. So if you look at the volume numbers in Q3, this year we did 6.9 lakh TVs as against 8.3 lakh TVs same period last year. But if you look at the 9 months performance, there is a growth of 16% and we have done 26.7 lakh TVs in the first 9 months, which is a growth of almost 16% as against same 9 months of last year. Now the major reason, of course, one is of course the volume degrowth, mainly because of the Diwali impact, and second is of course another 25-28% kind of an impact which we are seeing on account of the open sale prices coming down. So just to share some numbers on the weighted average selling price that we had in Q3 last year was somewhere around 16,000 crore, mainly because the open sale prices were higher and it's a prescriptive business to pass on in the selling prices. And now the average selling price for the complete portfolio of TV has come down to almost 11,500 rupees. So there has been a significant pricing degrowth, which has also led to the revenue degrowth overall.
So Bhumika, taking forward what Saurabh has shared, as far as the demand is concerned, we are fairly confident against the volume of 2.9 billion that we did last fiscal. We should have around 20% growth in volume terms in the current fiscal. The market itself is not growing, but we're going to have this growth because of certain new customer acquisitions and a larger share of pie of some of our anchor customers. So we should be closing at around 3.5 to 3.6 million in the current fiscal, which one feels is a decent growth.
Ramp up in the fourth quarter from the current levels of third quarter of 6.9.
Yeah. So responding to your question of the business opportunity on the Google side, first on the technical side, the product launch we are targeting sometime in Q2. The trials will take place in Q1. The licensing agreements have been closed and the various technology partners have been aligned with. So Q2 this should launch. One project has been signed with one of the brands. Please appreciate that almost 60-65% of the TV sold in India are on Google and Android platform. So we feel that over a year and a half, the opportunity pool in front of us is possibly of additional 1 million sets. That's what one is targeting through this route. The second, you would have seen the financial matrix that the margin profile is significantly expanded. The main reason for it is a step-by-step migration to owning the design. So these are two directions we are pursuing in LED televisions.
Sure, sir. Sir, on the second question is on the mobile segment. We've seen a decline even on a YOY basis, where we've been at that point in time, we were kind of still ramping up the Motorola volume. While there is some decline in terms of the industry demand, etc., but it's just surprising to see such a sharp QOQ kind of decline in revenues. So if you can throw some color of, how has been the decline in the Motorola volumes per se in the current quarter. And number two, if there is a delay in terms of client additions that we are likely to add into the current quarter. We were talking of earlier, revenue of about 5,000 crores in mobile. What is the risk to that number now? And as we scale up into the next year, what could be the risk from if there is a delay in adding any clients?
So Motorola volumes have been under pressure in the current quarter, which has impacted our performance in mobile business. However, in this business also, because of huge focus on generating more efficiency and cost optimization, the margins have expanded. Motorola, we are in discussions with them on how the volumes are going to pan out. And I think the next year business plan we're going to be concluding in a couple of weeks' time. They're assuring us that more export is going to come in, but let's wait and watch on that. On the new customer additions, one customer agreement, as I shared in my opening remarks, is going to close in a week's time. We are there. It's already been done. And we feel that it's going to get fructified as far as revenues is concerned in Q2 of the next fiscal. The other business that we are talking about to another large customer, we feel that it's going to take some more time. We are confident that we should conclude the other large customers' engagement also within the current quarter. As far as revenues is concerned, on the mobile side, what we are targeted for 5,000 crores, I think we should end up doing around 4,000 crores, somewhere between 3,800 to 4,000 crores in the current fiscal. Now these two new customers should add for us at least 5,000 crores in the next financial year. That's what we are looking at.
Sure, sir. And just lastly, what are the Motorola volumes in the current quarter?
In the current quarter, we are expecting the Motorola volumes to be around 800 to 850K.
Okay, sir. I have more questions. I'll come back in the queue.
Sure.
Thank you. Our next question comes from the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good evening, sir. So my first question is on mobile phones and lighting verticals, wherein we were anticipating an improved performance in Q3 when we had last spoken after the Q2 numbers. But the performance obviously has been far weaker than that. So just want to understand what really changed so dramatically, and the indications or the order book that we get from customers. Is that a very, very broad indication on which customers have a lot of flexibility to be downgrading their numbers?
So in lighting, Aditya, one, of course, the demand has been slow. The second, the unit value has significantly reduced with the migration from driver-based technology to DOB. Wherein there is a reduction in unit value of almost 15 to 18%. Third, there is always an internal reason. So it's a combination of three which has led to this Q3 numbers. However, a lot of internal work was done on value engineering, current asset management, working capital, which has led to the margin expansion to 9.1%, and we have reached the same level where we used to be year and a half back. Now the main thing is to grow the revenues. So in the current quarter, the revenue has already started touching more than 100 crores a month. We are in the range of somewhere around 110, 115 crores a month. So we are recovering. So I think with the addition of new product portfolio and some new large customers. Today, Havels is a very large new strategic customer for us. We are going to be on a reasonably good growth path with decent margins in this business in the forthcoming fiscal.
Sure, sir. And on the mobile phone side, is it that the slowdown was very stark and nobody saw it coming, or is it that Motorola is changing some sourcing strategy?
So in mobile side, there has been a slowdown, and we're getting a sense of it. And the key to growth in this business is the new customer acquisition, and that's what we are working on. As I shared, that one customer we have almost closed, which is 7 days away from signing, and another customer which we are confident about, I think we're going to close in the current quarter itself by March end.
Sure, sir. And when you speak about this 5,000 to 6,000 crore rupees of revenue potential, firstly, is that for next year, or given that we will be starting this business progressively over a few quarters, a lesser number is likely to be realized? And secondly, this 5,000 to 6,000 crores will be what proportion of the overall business that these customers may be doing in India if it's a domestic contract?
So in the current fiscal, we should close somewhere around 4,000 crores in mobile revenue. We feel that in the next year, because it's going to take certain time to launch the products for the new customers, we should be able to double it to around 8,000.
Okay. And so what proportion would this, whatever 5,000-6,000 crore rupees of annual revenue potential for these two customers be of the overall business that they do in India?
Sorry, just come again, please.
What percentage of business will be?
So just trying to assess the size of these customers.
Graduated shift, the potential is much larger. But I think first Dixon has to prove on its credentials and deliver on the committed deliverables. Then the scope is much larger. Please be rest assured.
So as I said, the opportunity is much larger, but initially, like the way it happens with us across verticals and across customers, it starts with lower volumes. We have to show our execution, delivery, and then gradually the numbers increase. So please be rest assured that the opportunity size and the customers that we are working with are much larger, and definitely they should grow year on year.
Understood. And just one last question: these customers, this contract is mainly for domestic market, or there's an export element involved?
So one customer is a combine of both domestic and exports of it, and another customer is mainly domestic focused to start with.
Understood. Thank you so much, sir.
Thank you.
Thank you. Our next question comes from the line of Niket Shah from Motilal Oswal AMC. Please go ahead.
Yeah, thanks for the opportunity. I had two questions. One is the new mobile order that we just talked about. I just wanted to understand what kind of margins will that order increment on that incremental revenue can we generate? Will it be at far more competitive margins as compared to what the blended margins of the business is?
So Niket, those margins will be definitely higher than what we are doing today, because so those commercials have been partly negotiated. So and plus the fixed cost gets absorbed of the top of the team there on a much larger revenues. Of course, you need to build a bigger team, but clearly there's some kind of fixed cost which gets absorbed over the larger revenues. So you'll have the benefit of operating leverage also kicking in. So yes, the margins in both these customers will be much better than what we are currently doing.
And I'm assuming the working capital cycle doesn't change in the new order versus the existing.
Yeah. So that focus will always be there. Initially, yes, there can be some deployment of working capital, but once the business ramps up and stabilizes, the working capital intensity will not be there.
Got it. And the second question was, within your existing segments across the board, all the segments that you're present, as we stand today, do you think there is likely to be any downward in estimates within the existing customers, either due to slowdown or change in strategy from that customer? The reason why I'm asking this question is, while new customer addition is obviously an area of growth for you, but the existing client also, when it declines, it kind of compensates for the higher growth. So just trying to understand that, one is on the new customer addition, there is clearer tailwind, but do you think within existing customers, is there any scope for downgrades? Thanks.
Niket, taking you through the various businesses, we shared with you that in the current customers business, there has been a pressure, there has been a challenge. Taking you through the other businesses, starting with LED televisions, the current order book looks good. We are also working on some new customer clients. With the current order book also, we are going to have almost 18 to 20% growth. In washing machine, we have an extremely good order book with existing customers itself. In the current fiscal, in semi-automatic, we're going to grow from 1.1 million that we did in 21-22 to around 1.5 million in the current fiscal. And this trend is going to continue. We feel that we're going to have almost 15% growth in the next fiscal with the current customers itself. In the new category of FATL, obviously the base was small, so we're going to be doing almost 160K in the current fiscal, and this quantity should double in the next fiscal. In lighting business, we had a challenge, but please be rest assured, we are on an extremely strong recovery path. And month on month and quarter on quarter will keep on going in our existing businesses itself in lighting. Then we have security surveillance systems. Security surveillance systems is going to have a challenge for a quarter or so because we're shifting the campus to a new site. So there will be some additional costs. And the volumes are going to be fairly steady with a single digit growth. Then we have the new businesses. In new businesses, wherein we are in wearables, there is going to be significant growth because we're going to be adding new SKUs for both. Then in telecom devices, that is a new business we just started with Airtel, and that's also going to be a high growth business. So this is going to be the trend. We feel confident about our existing businesses as well, except for mobiles, wherein we are working on new customer acquisition.
Got it. Perfect. Thank you so much, and I'll come back in queue.
Thank you. Our next question comes from the line of Ankur from HDFC Life. Please go ahead.
Hi, sir. Good evening. Thanks for your time as always. So one, if you could just remind us on your top line and margin guidance for 23. Obviously, we are very close to completing the year, and also overall any guidance for 24 on top line and margins.
Yeah, so Ankur, we did around 9,100 crore, 9,200 crore revenues in the first 9 months. Broadly, we should end quarter 4 somewhere between 3,000 to 3,500 crore of revenues. That should take us to broadly somewhere between 12,200 to 12,700 crore revenues. So that is a broad guidance. But I see that the margins in Q4 should also be on, if not on the similar lines, at least much higher than the quarter 1 and quarter 2 numbers. So we are hoping to close that closer to 4% kind of margins. As far as the guidance for next year is concerned, clearly we have a big growth coming in all the verticals of variables, telecom, TV as you mentioned can be a 15 to 18% growth. Fully automatic washing machine can be 100% growth for us because the business just started to ramp up now. Mobile, as you had guided for, we're looking for these 2 customer account acquisitions, and this will really add to our top line. So somewhere between, I would say next year it can be somewhere between 90 to 40,000 crore kind of revenues, somewhere between 90 to 21,000 crore kind of revenues. But we are in the process. In the next couple of months, we'll be doing our budgeting exercise for next year, and I'll be in a better position to share those numbers with you. But this is the broad numbers that we should look to target for next year.
Okay, fair. Second, sir, and not just for Dixon, but for the industry as a whole, we've been hearing of a slowdown. When we look at GSK numbers, for example, for ACs, refs, washers, the numbers which are out for October, November, and I understand the Diwali piece being slightly, earlier last year, but still, we see, single to high single digit declines. As you said, even on TVs, we've not seen any growth, at least on the industry side. So how are you seeing, at least for the near term? So I understand 24, maybe you obviously because of new customer additions, etc. Dixon may see growth, but on the overall industry, if you could talk about some of the larger segments, what are you hearing from your end customers?
So I'm kind of sanguine about it. what you are saying is correct. So we have to keep watching and let's see how it evolves. So we can't be absolutely gung-ho about it. I think it's going to be guarded kind of growth in existing businesses. In Dixon's case, what is extremely important is to run the existing businesses much more efficiently, acquire new customers, widen the product portfolio, and ensure that the new businesses that we have entered into are executed well. That's going to be the key trigger for Dixon's growth.
Right. And so, sorry, just on the lighting piece, if you could remind us, I think that's been weak for quite some time. So, and I know that's for the industry as a whole, but what's really driving that? Is it, is it that the penetration levels are high and because we also spoke about some drop in pricing. I'm sorry I missed that. So, what's kind of driving this weakness in lighting again?
So, in lighting, we feel confident that we are on a correct recovery path. We're going to have growth in value turnover. We're going to be adding new SKUs. We're going to be launching the new product of strip and product lighting in the current quarter itself. We have built our R&D team for professional luminaires, which are going to be launched in a couple of quarters. We're going to start leveraging our acquisition on the smart lighting front. There's a lot of effort going into value engineering and cost optimization, which has led to the expansion of operating margins from 6.7% to 9.1%. We feel that we can sustain these margins. So we feel that lighting, we're on the right track and the right steps have been taken. The team has been built to put us on a growth path. Undoubtedly, the current year has been a challenge, but please be rest assured that we are on the right path. And this quarter itself, there will be a significant recovery.
Okay, fair. And just one last one on cell phones again. And, given I think our earlier guidance was a number closer to 5,000 plus, now we're talking of around 38 to 4,000 crores for this year. And as you mentioned, right, Motorola volumes have been a little weak, but what's really driving that? Is it just their end market where they sell, things going slow? You're just trying to understand a little more. And do you think that's going to come back next year, or will volumes remain low from Motorola, and therefore a lot of the incremental sales has to come from these two new customers? How should we kind of view that?
So in Motorola's case, their market share in India has sustained. But what we were expecting, the volumes to come from exports to US, that did not materialize. Because the global markets, particularly the US market on the smartphone side, and in Motorola's case, most of the export was to operators, those numbers really dwindled. That has impacted us. We are discussing with Motorola for next year's budget. We have not concluded the numbers. We are hoping that numbers are going to be decent. Let's see. But we have not still concluded the numbers. The other customers and new acquisition I've shared with you. We feel confident that these new customer acquisitions are going to materialize, are going to happen very soon.
I understand. Okay, sir. I understand. Okay, great. That's very helpful. Thanks.
Thank you. Our next question comes from the line of Sonali Salgaonkar from Jefferies. Please go ahead.
So thank you for the opportunity. So my first question is, we have seen a good rebound in margins. What was the quantum of price hikes that we have taken on an average in this quarter?
So it's basically a lot of value engineering initiative, Sonali, and also cost optimization, reducing the manufacturing cost, and also passing on certain increasing in the commodity prices to the customer. It takes certain time. We have shared with you that in ODM business there is a certain lag in that. But in the last quarter we have been able to do that. And that has led to the increase in operating margins in the businesses like washing machines and lighting.
Got it. So in our ODM, it's still at about 30% of the sales, right?
ODM is around, in the first 9 months, Sonali, ODM is around 24% of our sales.
Okay, got it.
ODM is being a very large contributor to our profitability now. So almost 48% of our operating profits are coming from ODM business.
So last year, it was around 20 odd %. So first of all, 20 has moved to 24 and on a much higher revenues. So in absolute numbers, the ODM numbers are growing very fast.
Got it. And lastly, on the exports, can you quantify our export revenue for the first 9 months?
So my export revenues is majorly Motorola and a small bit in lighting. We had an export order to UAE markets for lighting business. So broadly, I may not remember the exact number, but it should be somewhere in the range of 700 odd crores, 700 to 800 odd crores.
Got it. And how much do we expect to increase that over the coming year?
So this year we should close at somewhere around 1100 odd crores. And hopefully by next financial year, as we mentioned, that we are waiting for Motorola to give the guidance on exports for next year. So that should increase the revenues for next year on export side. And one of the new customer acquisitions that we're looking for will be both for the domestic market as well as for exports. And hopefully in lighting business also we should crack some more accounts on lighting. So yes, my sense is that number should grow at a good pace. Very difficult to quantify right now. But
so my sense is, Sonali, that it will be somewhere in the range of around 2,300 to 2,500 crores next fiscal.
Got it.
Let's see how the Motorola plan pans out, but that's what my sense is.
Got it. So, and lastly, you guided for rupees 8,000 crore sales in mobile phones in FY24.